Hello, investors. This is Chanel. As promised, in this episode, I'm going to walk you through different investment strategies that manage funds use and how you should do your due diligence on the operator. Well, look, end of the day, it's your money at risk. So make sure you do your homework before you handing them over your money.
Welcome to Cashflow Formula, insights into the world of investing, and learn how to build wealth through cashflow, simplifying the complicated world of alternative investments for you. If you like what you are hearing and want to learn more, consider subscribing to the show wherever you listen to it. Here's your host, Shanil Werasinke, founder of SNW Investments.
As mentioned in my last episode, there are two types of managed funds out there. So what I want to focus in on is the unregistered managed funds, because that's a gray area for many investors and operators. If you are a retail investor, there are many registered managed funds that you can invest in are on the ASX website. I'll put down a link in the show notes if you want to check them out. Alright, let's start with investment strategies managed funds typically use. A fund or a syndicate can be structured to following three ways: a company or a trust or a managed investment scheme. Those are the main three ways that fund can be structured. I briefly explained key differences in these three types in my last episode, so I'm not going to explain them here again. I'll start with a single asset syndicate. The most common ways to structure them is to go with a proprietary limited company or to set up a unit trust to acquire the asset. You know what the best thing about these syndicates? And that is, this structure allows you to raise capital for any project or asset that you want to acquire. This is exactly how those big funds raise money, but they act as managed investment schemes rather than single asset units or company. However, if you're getting started in this space, your best shot is to go with either as a company or a unit trust. If you're an investor looking to invest in one of these syndicates, here's how you need to plan your way into one of them. First, you need to figure out if you want to be an active investor or a passive investor. Depending on your answer to this question, your path may differ. If you don't want to get involved with the day-to-day tasks with the trust, you tend to go down the path of a passive investor, and your option is to look for a managed investment scheme with a good operator. On the other hand, if you're capable of engaging day-to-day tasks with the underlying asset that your trust or the company holds, you're taking an active role as an investor. There are so many horrific stories you can find out about these types of managed investment schemes if you look up ASIC's website. That's because investors tend to do less due diligence on the investment scheme, and then the fund manager either disappears with the investor's money or just simply lose it. There are two scenarios in such a case. Either the fund manager is simply an idiot who just lost investors' money, or a crook. The reason I want to talk about them is that there have been many instances in the past that investors lose their hard-earned money to these types of people. Let me quickly bring you one story that happened over the past couple of years. Here's a story about one financial advisor from Queensland and how he managed to put his client back on Centrelink. This incident happened between 2013 and 2015. Ben Jayaweera was a financial advisor with many clients. He owned a firm named Growth Plus Financial Group, and through this financial advisory firm, he met his clients. While he was advising to these clients who happened to be in their retirement age or close to that, he was suggesting that it would be better for them to diversify their retirements through the managed investment scheme that he knew about at that time. The managed fund was also known as Australian Diversified Sector Income Fund, ADSIF in short. He went on to advise his clients that the fund was diversified through cash, property, shares, aquaculture, and agriculture. In reality, the only asset that the fund was holding at that time was an abalone farm in South Australia, which obviously owned by Mr. Ben. He managed to raise about $6 million to this fund. And the time went by, and Ben was bleeding money from his abalone farm and ended up in a total loss. The investors complained about not getting paid from the managed fund. And then ASIC found Ben was guilty of misleading investors and sentenced to 12 years imprisonment. The sad part is real losers here are the investors who failed to conduct proper due diligence on the investment scheme. Just because ASIC classify most of you as wholesale investors doesn't mean that everyone else is looking after your interest. You still need to ensure that you conduct a proper due diligence. Now let's see what you need to know before you want to invest passively in an unregistered managed investment scheme. First of all, you need to thoroughly conduct a proper due diligence on the operator and his background. Do a credit check, ask for referral, good and bad ones. If the operators are a group or a team, dig into their experience and how often do they communicate with their investors. Then most importantly, you need to verify if they have skin in the game, which means if they have money in the deal with yours, or are they simply after your money? Then lastly, you need to verify if they have resources in place to do what they claim to do. Doesn't matter if you trust them a lot, you still need to verify all the claims that they make to you. Once you have these verified, then you can look into their offer to see if that makes any sense to you. Here's how you need to crack this down. Starting with the deal structure, then the financial metrics, and then the process and the timeline. Let's break down each of these now. Deal structure. Here, you need to make sure that whatever that you are offered is in compliance with ASIC's rules and regulations. Go listen to my previous episode if you want to learn more about those structures and their differences. Then obviously, you need to know how each party is being paid in the syndicate. This is also known as waterfall structures. Shoot me an email to info@cashflowformula.com.au if you want me to create an episode on waterfall structures. Then financial metrics comes to the scene. And here you need to make sure that whatever you are shown as projected returns are conservative. I have a whole episode coming up on underwriting in which we're going to talk about how to conservatively underwrite a deal. Then most of the time there is a minimum investment that they accept to the fund. Those are few of the things that I can think of on top of my head right now. Let me end this episode with this. Trust but verify. It's simple as that. Alright, in the next episode, I have one of my good friends coming onto the show to help you with sourcing a real estate deal for your managed fund.
Thanks for listening to the show. Remember to join us again next week for another episode. Learn more about what we discussed here by visiting our website cashflowformula.com.au. Until next time.